Hey, everybody. Welcome back to Everything Money. As always, it's Seth, Paul, and Mo talking in our glorious studio. Paul, we have such wonderful support all over the world from our subscribers and patrons. You know we love you. Today, we're talking about Cisco. Paul, what a company. Tim and I were sharing a story. We really love Manesh Pabrai. Obviously, the first chapter in Richer, Wiser, Happier, the book. And he was telling Mo shared an interview last night that we all jumped on, and he was talking about Cisco in 1999. Tim, Manesh was getting stock tips from a cab driver, talking about how this was the biggest company in the world. And sure enough, Paul,
Are you being a snob?
We are entering the realm where
we're not entering the realm. We're in the realm of I go play golf and my 18-year-old caddy is telling me how I'm missing it on Palantir and Bitcoin and how I'm wrong and blah, 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 blah. And when you read articles in which they say, let's ask these three teenage experts on stocks. Let's ask these three teenage experts on cryptocurrency. It's like, do we not see history repeating itself right now?
So unfortunately, Cisco had a grand run-up in the early 1999, 2000s. And then, of course, Paul, behind you, you can see what has happened since. Now, please, for our new investors and new viewers, explain to them the idea that just because a company does well, it does not mean that their ticker price will do well. Show the graph. It's astounding.
So let's go really quick and look at the income statement from back then. In 1999,
$11 billion or something?
Cisco did $11 billion in revenue. If I told you in 1999 that the company over the next 20 years
would 4x,
would
5x.
more than 4x, 4.5 times their revenue, would you have believed that I said their stock would still be below their all-time high?
You're stupid, Paul. You don't get growth.
Of
you
course.
Don't get it.
And for people who tell me that's impossible, this is what happens. Overvaluation makes your returns in the future worse. Everything is driven by profit and cash flow in the long run. Everything. Literally 4 times higher revenue. If I just put this blankly and said to you, let me ask you a question. Where do you think revenue has gone in the last 20 years? Somebody would tell me, oh, it's down. It's 48 billion
compared
here
to 11
versus 11 billion here. And you're going to tell me right now that us paying $600 billion for Tesla or even a $2 trillion for Microsoft is a reasonable number. Guys, there will be companies that are very, very large and very successful today that will be selling for less money 10, 15, 20 years from now because of the exact same issue.
Paul, I try to explain this to normal people, and literally, as you're saying, I'm trying to explain it to myself, the idea that, yes, we always relate this back to Tesla because it's so overhyped and overpriced. And
it's so many other companies
and
today.
Very exciting. But the point is you're already paying for the growth that you may never get. So if they build the Gigafactory, Mo, and if they build all the cars and they're bigger than Honda, you're already paying for all that success. And we see it again. We already paid for Cisco's success 20 years ago.
And on top of that, how many shares do they have outstanding right now? They have 4.2 billion shares outstanding. Back in 1999, they had 6.6. So not only is the stock down still, they've also eliminated 1/3 of their shares, which should drive stock price up. So if they kept the same number of shares outstanding that they did, this stock should be even further down than it is right now. So guys, before you go forward and look at companies and look at Amazon. Amazon hit $113 a share in 2000. It is now at $3,400. That's call it 30 times more. But their revenue is over 200 times more than it was in 2000. So even the uber successful story of Amazon, it's not even matching its price per share growth versus revenue. The revenue is 200 times more in today than it was in 2000, yet the stock is only 30 times higher. Because if you overpay for something astronomically, now I do believe in overpaying for growth stories. Absolutely, you should pay more than what the most recent cash flow justifies.
You've done this with Alibaba recently.
I've done it with real estate. My most successful real estate deal ever, I paid full ask price and actually paid more than full ask price to get the property, and it was worth about 20% less than I was paying for it on those dollars. But I knew that the rents were too low.
Yes.
So now it's my most successful deal. It's tripled in value, made a ton of money, over 40% returns. Same thing happens with stocks, guys. This will happen over and over again. It will happen in this market. We're going to look 10, 15, 20 years from now and look back and say, remember when we thought a Tesla was going to be a $2 trillion, $3 trillion company? Well, look at it now. That doesn't mean, by the way, the companies don't have to go out of business for it to, Cisco didn't go out of business.
No,
Their business became better.
They're doing very well.
Yeah.
Their business became better.
Yeah.
Their profit. Oh, we didn't even look at the profit here.
I think the point too, Paul, is I try to explain to normal people is yes, you might win on Tesla, but as you always say, if you bet on 100 Teslas, you're going to lose out on 99 of them, even if you slay one of them, and you're still not as good as you would have been.
In 1999, Tesla made about $2 billion. Cisco made about $2 billion. What did it make last year? $10 billion. Over 5 times more. So does this chart, based on what everybody thinks is supposed to happen with companies, does this chart look like
a 5X,
profit here went up 5X?
A 5X banger. Nope. Yep. Get your
Does this look like, if I told you back here that your profit 20 years from now will be 5 times more, you'd be like, oh, stock's gonna be up here.
Yeah.
But why isn't it? And by the way, this isn't the only situation. Intel had the same thing. If the companies even stayed around, I guarantee you, Microsoft, Apple, Amazon, if you go look back at the 1999 numbers, I guarantee you that their revenue and profit is up way more times than their stock is up since then.
Oh yeah.
Because that's what happens with overvaluation. Over long periods of time, what drives valuations?
So we'll get into the current valuation, but the funny part about this graph behind you, Paul, it's a ticker, is if you take out this huge hill, this huge story in the dot-com bubble, it looks like a nice, growing, consistent.
Absolutely.
You know what I'm saying?
Absolutely.
So as a viewer, folks, what you need to do, and we're currently today doing this, is you just have to watch out for that bubble and not buy when all these other yahoos are telling you.
This is parabolic. 1997, 2000, 3 years, and you saw price go from 10 to 80. Guys, this isn't, I'm not some, you always joke and say prognosticator because of the line from the movie. This is just math.
Mm-hmm.
It's just math. And if you fight this, you're going to end up losing a lot of money because profit here is 5 times more than here. Revenue is 4.5 times more than here. Yet the stock is still down. And the stock is still selling for 23 times earnings. It's not even cheap. That's the funny part. It's not even cheap right now. So it's taken an overhyped market right now to even get to the point where it's $55 versus an all-time high of 80. And it took an overpriced market to even get there.
So if you're still with us, we're going to use our 8 pillars to take a look at the company today, see the financials behind Cisco, what they make, their shares, all of this to see if the stock price is even affordable in terms of value investing today. Paul, would you like to go through it for our new viewers?
I would love to. So this company, big company, $235 billion market cap. We've got a 23 PE, which is an X because we want less than 20, but a great profit margin of 21% stuff.
That is good.
Yeah, they pay a lot of dividends. 2.6%. That's a solid dividend. The market's, it's about double where the market is today. Yeah. And Seth, they spend about $6 billion in dividends. Now, explain to everybody out there why we look at dividends and what we have to look for in the dividends.
So for our dividend investors out there, this was news to me as I've gone through the show, is that obviously dividends are not always safe. You have to have the free cash flow to pay for these. And there are companies, Paul, that are dividend traps. We looked at Geo Group, AT&T's getting rid of their dividend, pissing off a lot of our dividend investors. So they have to have the free cash to pay this dividend out. And it looks safe with Cisco. Look at that free cash.
Why does it look safe?
Well, they have so much of it.
Correct. They had $14 billion in free cash flow last year. And over the last 5 years, they had 13.9. They can easily afford the $6 billion dividend, which I love. The other great thing is return on assets, double digit, return on invested capital, double digits. So right now, apart from the PE, Cisco's looking good. In fact, some would argue with such a high return on invested capital and assets, you might be able to justify a higher PE. But we'll see in the stock analyzer tool we use soon.
Let's do a couple more pillars and we'll tell them about the software, Paul. Pillar number 3 is revenue growth over the past 5 years.
Look at this boring, stodgy company.
Boom, boom, boom,
48.5, 48.85. It's still a check, but boy, is that boring. Look at the last 10 years. It's a very boring company. So my initial reaction is, okay, why would I pay a higher PE? More growth potential.
Yes, it's not growing at all.
It's not growing. So I got to sit there and, in fact, how do you even justify, this thing's growing 2% a year maybe. That's okay. Let's go look at the profit.
Profit growth over the past 5 years.
10 billion, 10 billion. Check mark.
Okay, check mark there.
Now, look at this. There was a big drop here in 1 year. I guarantee there was some write-off they did.
All right, Paul, let's take a look at shares outstanding. We want this number going down. We want them to be buying back shares.
Yes, and we saw relative, we were looking earlier in the video from 1999 to now, they're down about a third. The last 5 years, 5 billion down to 4.22. That's a check mark. Now, guys.
That's 16% difference, Paul.
And this is where I think we're going to get a lot of our growth in the share price over time. They're going to use that extra cash flow they have without much growth potential and say, how do we reward our investors? We're going to pay them dividends, which is a tax inefficient way, but investors love it. or we're going to buy back shares, which is an extremely tax efficient way to increase your per share value because it drives up you get a bigger percentage of the profits and revenue as they buy shares back.
If this process resonates with you and you're trying to invest without having this data, you can get it right now by joining our Patreon. We are moving off of Patreon within the next 6 weeks and moving just straight to everythingmoney.com, but you can join us and get access to the software, which Paul is going to tell you about right meow.
Okay, so guys, we created a software because so many people were asking us, how do we get software? Because I was using other software. So here's Everything Money. It's 84 cents per day, guys. This is less than a crappy cup of coffee. Literally, if you go to your local Speedway and buy a cup of coffee, it's $1. This is 84 cents. It gives you all of these things. You got the mobile app, the 8 pillars, 30 years of financial data, the stock analyzer tool, exclusive daily content just for you, access to all 3 of us, real estate calculator, retirement calculator, and the Discord community of over 5,000 people who speak about investing in a very organized way. Again, 84 cents per day, guys, and we give this to you for only 84 cents a day. This will pay off huge dividends in the future for your retirement. If
you feel alone out there in your investing journey, you can join our Patreon, click the link below, and join us in our community to help make better decisions with your money. Paul, shall we get into Cisco's current assets over liabilities, which is pillar number 6?
Absolutely. So we go to a balance sheet. And by the way, this is one of the metrics that Mo and I have been talking about that we're going to switch, but it's going to be a very exciting metric we're going to change it to. $37 billion in current assets, $24 billion in current liabilities, plenty of cash on hand to pay off their current debts.
Great. Now, the mamma jamma is free cash flow growth, Paul.
Now, free cash flow, guys, is cash from operations less your capital expenditures. Now, what this does, it allows the company to go buy back shares, pay dividends, make acquisitions, and pay down debt, okay? This will be another metric we're going to talk about for our new 8 pillars, but we went from 12.67 to 14 billion for an average of 13.9. 13.9 times 20, and we're only starting with 20 because $280 billion. What's the current market cap?
235 bill.
So it's a check mark there. I think this is all but one check mark here. Now, the reason we start with 20, guys, it's a very common question. It's a starting point. If your free cash flow is growing steadily, you should be willing to pay a higher premium. I don't think 20 is the right number for this company, but we just pick one level. We sit there and say, let's just start at this level. So I do think based on their lack of growth, you should pay a lower multiple of free cash flow.
Well, Paul, will you pull up the 8 pillars? Because what I'm not getting is how the price to free cash flow is 17, but the PE is high. What's that relationship?
So the price to free cash flow here is based in 5 years average, and this is based on the 1 year number, okay?
Okay.
So the PE of less than 20 is just for 1 year, and the price of free cash flow is based on a 5 year number. So they've had very consistent cash flow over the last 5 years. In fact, they've had a few years that were a little bit higher than other ones. So this is why it works. And a lot of people would sit there and say, look at your 5 year PE, which is a very reasonable thing to do. And it might be something that you do personally, but right now, 7 out of the 8 pillars, I do love all of it. I don't love this because of their potential. Once Mo's done going through the chart, I'm going to load the stock analyzer tool, which will tell us exactly how much we should pay based on our assumptions, not based on any other free due diligence. And by the way, for those of you out there, we do not do due diligence on these companies ahead of time. You are wasting your time if you want to understand very important details of the company. Even if it's 500-foot view, I don't even Google anything. Why? There's 10,000 stocks out there for me to choose from. I need to figure out an efficient way to weed things out based on the things that matter to me, which are these 8 pillars. These are what matter to me. I use this as my screener to then go, okay, I'm interested in the stock. I can already tell you right now, I'm interested in Cisco. Even though this is an X, I'm interested because it's boring. It's not growing a lot, which means most people probably hate it. And it's probably going to sell for lower prices and they're buying back shares.
Back in pandemic day, we owned shares of Cisco. I mean, we sold puts on Cisco.
We did.
I remember that.
So selling puts is the way that we generate income to then get shares in the future for our own ownership.
Yep.
If you're looking to trade Cisco at a more exciting pace, you can join Mo in the Bidnass Nation, and he'll show you exactly what he's doing trading this on a daily or weekly basis. Go ahead, Big Mo.
So looking at Cisco, this is one of those stocks where right now it's struggling because it's falling into moving averages. But you can see that your trend is starting to turn down on you just a little bit. But here you're at all-time highs, Seth. So let's go over to the daily chart and just take a peek. So right now, you're really hovering right above this 50 and 25-day moving average. Now, the thing that gives me a lot of hope for Cisco is look how consistent their volume is. Every single day, they're getting very good volume coming into the stock. Now, What are you going to need? You're going to need good volume coming in and to break out over this resistance point to make a new all-time high. Cisco is one of those great stocks where, looking back in 2015, 2016, you could have grabbed Cisco all the time coming through the sweet spot because it has consistent volume. It has consistent buyers coming in. So you could have always grabbed it coming through the sweet spot very nicely and you get a nice climb. You would often not have these little blips. So it would turn into a power stock. And what a power stock is a stock that is over all 4 major moving averages, making new all-time highs. So looking forward to the future, I think Cisco, if you're going to be a power stock chart reader, Cisco is something that you need to keep on your radar. So when it makes those all-time highs, you can catch it from the bottom, going through the sweet spot all the way to the top, and you can make enormous gains. This is like an AT&T kind of company.
I love when you pull back these charts, Mo, because you can see if you would have followed your rules when it turned into the sweet spot, the 32%, then it goes up, then would have broken down the other direction, and you just follow the rules.
Exactly. And when you run up, you would have made this great gain, then you would have sold when it broke down. And really, it just consolidated here. It didn't really lose in price. So right when it made that sweet spot reversal and came back up, it could be right back in it again. So it works. I mean, of course, this is Monday morning quarterback seeing it, but it also is good to know that when you look at chart after chart after chart, if you just follow these rules, it works. The majority of the time it's tried.
And follow the rules to the T. Yep. Take your emotion out of it. Take your guessing out of it. If the chart says do something, do it. Don't deviate. Every single chart, every single momentum method I've seen in the past, or even things like the little book that beats the market, the second you input your own personal opinion, you start to suffer. Just follow the charts exactly. The second it hits over that line, you buy. The second it drops below that line, you sell. That's it.
Along similar lines is if you want to determine what you should be paying for Cisco, say it meets your 8 pillars or your criteria, you get our stock analyzer tools being part of our Patreon, and it shows you can make some assumptions and it'll come up with a price range you'd like to pay for this. Paul, go ahead and walk us through this a smidge.
So guys, Cisco's not a fast growing company, right? In fact, there's some decline. Your job as an investor is to look at low, middle, and high assumptions. Be conservative, because our goal here is to buy stocks that we think will beat the market based on what we're buying them for. You're not going to get the growth out of revenue for Cisco. You're not going to get the growth out of profit and free cash flow. You'll get the growth because they're buying shares back and they're increasing your ownership of the business. So you're getting a bigger and bigger piece of the pie, even if the pie stays the same size, right? So here are my assumptions. I did a 7-year analysis. I always do 7 years on big companies like this. I actually assumed 1% revenue drop for the next 7 years, 0 and 1%. Buying back shares, low side of -2, high side of -4, profit margin, free cash flow assumptions, PE. I think PE is 12, 15, 18. I don't think 18 is justifiable here, by the way, guys. I probably wouldn't even put 18 in here, even if it's a 1% dividend revenue growth. And my return, I put 15, 12 and a half, and 10. Hit my analyze button. And what does it tell me? Cisco's just expensive, okay? There's only one price here that works. So I'm sitting here saying, okay, I usually want to be around this range. So it's probably high side 40, low side 30. Now, you might sit there and say, Paul, you're being too conservative. Great, on the revenue growth. Let's say they have a plan to really kick butt. I'm going to take their revenue much higher. It's still expensive, and it doesn't increase the price by a ton. Now, guys, 55 can become 40 very quickly in any market, especially this overpriced market.
It was $44 in March, just a few months ago.
In March of this year.
Yeah.
So guys, we're not far away. Just be patient. Add this company. We're going to be having watch lists here soon where you'll be able to put these companies on your watch list. It'll notify you when it hits the price you want. Just make sure you keep a watch on this one, because this is a company that, with their aggressive buying back of shares, I think you're going to be able to do very well in it. And they're paying a pretty decent dividend.
Yeah.
That is our take on Cisco. It's a hold at the moment, as our employed traders would say. For Mo, it's a hold currently, and we'll certainly update you moving forward. So thanks for watching the video. Tickle that thumbs up on the way out. Join the Patreon, and you'll love it. We'll see you next video. Thanks so much.